Welcome to the Weekly Juice podcast, where we discuss all things real estate, personal finance, investing, and entrepreneurship. Whether this is your first time here or you're an avid listener, we're thrilled to have you as a part of our community. Our goal is to share stories of successful entrepreneurs and investors in the hopes that they assist you along your journey towards financial freedom. We discuss successes, failures, systems, motivations, experiences, tips and tricks, and key lessons learned over time. After each episode, you should feel motivated, empowered, and prepared to take action in your own life. Make sure to tune in every Wednesday to get your weekly juice. You can also find us on Instagram at Weekly Juice Pod, where we post daily content, personal finance tips, and document our own journey towards financial freedom.
Welcome back to the Weekly Juice. As always, it's your boys, Ryan and Corey, here with another episode for you. Today, we had on special guests, Chloe from Bear Money Coach. She is a personal finance coach and blogger that helps folks make their money work for them. She specializes in debt payoff and helps people get their financial house in order. She's paid off $40,000 worth of debt in 2 years while saving over $150,000 for retirement, and has scaled her portfolio and net worth to over $300,000 in just about 3 years. So she's doing it all. She is on track to retire by 46. Not that she will, because she's finally found her passion she's an influencer in the financial independence, retire early movement space.
She is. And she came from a place of kind of financial, like she didn't really know what she was doing. And then she started tracking her journey. And what that did was to create accountability for herself. And then she started to pay off debt. And the whole going up by $200,000 of net worth in the time frame that she did it is a seriously big accomplishment. And then it's gone up even 100,000 more since then, since she started using that as one of like her taglines. So she is the person that you want to speak to if you are looking to get everything finances and investing set in one direction. And she has courses, she does coaching. She's a really, really good mind that is going to be able to do whatever she wants to do in the next 10 to 12 years.
Super relatable and easy to talk to. And I think of when you start talking about your finances, it becomes very personal for people and daunting in a lot of aspects. And Chloe takes that away and just humanizes everything. So from a person that has come from not making much to now she has a net worth probably over 300,000. I know that for certain.
For sure.
And has her finances efficiently in order, paid off debt, and just she is one to learn from and can help you certainly get your house in order no matter where you are. And she's also studying to be a CFP right now. Yep. So she's doing everything. She's really fun and entertaining on her social.
She does great reels. They're really funny.
Yeah. So we had a pleasure working with her today. And I think you guys are going to enjoy the episode.
Let's do it. Let's bring her in.
Chloe, officially welcome to the Weekly Juice podcast. Corey and I are very excited to have you on here. We've been following your journey on social media for a long time. Outside of the phenomenal dancing, we love the nuggets you provide on personal finance. You're one of the top dogs in the financial independence community, at least what we believe to be.
For sure.
And so we're thrilled to have you on the show. Thanks so much for coming on.
Thank you so much. I'm totally honored to be considered a top dog, at least with the dance moves. I feel like, I'm at least the top dog in the dance moves in the finance industry.
Probably the number one top dog for dance moves. Definitely in the top 5 for financial independence.
I agree. Totally agree. So if you could just give a little brief background on yourself, who you are, where you're from, and then how you got into the personal finance FIRE community and have made a name for yourself.
Yeah, sure. So as you guys said, I'm Chloe from Bear Money Coach. And really what I focus on is teaching people how to invest. I kind of started off teaching people, a little bit about budgeting and just random personal finance tips in general. But I kind of pivoted just more into really just focusing on investing, just because really I like working with the 80-20. And when I think about building wealth, I think that out of the 80-20, are you guys familiar with that rule?
Yes. Yeah. Like
okay,
80% of you can, depending on how you want to look at it, 80% of your problems come from 20%, or 80% of your solutions come from 20%. So
exactly.
Yeah.
Exactly. Well, when you're thinking about and applying it to finance, the wealth building, I always focus on really building your wealth through increasing your income and investing. And investing is obviously a way to increase that income as well. So anyway, I now really focus on teaching people how to invest, specifically through the Lazy Investors course. But I actually started this journey as a mental health and relationships blogger way back in 2017. And so when you go to clobear.com, you'll see a lot of my old stuff from when I was writing about mental health and relationships. And, I kind of just like chronicled my journey through those things. And as those things for me started to heal and like I continued to grow, I really couldn't ignore the fact that I was really bad with money, and being bad with money was impacting pretty much everything in my life, from my relationships to my mental health. And so I was like, well, I guess I got to start focusing on improving this. And I had no idea what I was doing, but finally I believe it was October 2018, I was like, you know what? I'm just going to start chronicling this in the same way that I've done it with everything else. And I just started tracking my spending and sharing it on the internet for everybody to read. So it was kind of my approach to life. And a lot of things that I do is just do it and you'll figure it out later. And that's really how Clobear came around, specifically on the money coaching side of things. And, you guys can probably relate once you fall into the finance industry and once you discover financial independence. It's just this rabbit hole of like, you just want to learn more and more and more, and you want to become more and more efficient with your efforts towards financial independence. And so that's how it just slowly became my obsession. And finally, in 2020, I decided to really stop completely writing about mental health and relationships, because I just didn't care as much about those things because I wasn't struggling with those things anymore. And I really was, for a while I was thinking like, okay, what do I want to be writing about? And at the end of the day, I wanted to be writing about finances. And so in 2020, I kind of made that pivot. And then in January 2021 is when I finally decided, okay, I'm going to take this seriously and build it as a business. And I was able to quit my job in October 2021.
Unreal. That's a testament to anybody who has imposter syndrome. You went from somebody who was, you self-proclaimed bad with money, right?
Truly.
And just started sharing like your money story. And now you have 50,000 followers from starting from, you didn't know anything when you started. So it's like very cool to tell people out there, start your journey and document your journey, because it's relatable. People want to know about what's relatable. And now they can look back and be like, look how far Chloe's come. Like I can follow her journey. It relates so much to my own. So I commend you for that, because it's tough to start, especially when not only you think you don't know what you're doing, but you actually don't know what you're doing. So
well, you don't know what you're doing. And my thing was like, at least if I'm blogging about it, it's going to keep me accountable. And I knew it was something that I had from the time that I moved to Chicago until I quit my job. I had made more money every single year. If not like, I had like consistently made pretty significant bumps in my income. And yet I kept living paycheck to paycheck. And in that October 2018, I just was like, if I keep doing this, and I had finally made this like big job, and I was like making $91,000 a year, which was more money than I ever thought I was going to make as somebody with an English and Spanish degree. And I was like, if I don't pay attention to this, like if I don't do something about this, I am just going to end up spending all of this money and wondering where it went. And, I decided if other people can do it in the FI community, there's no reason I can't at least try.
Absolutely. And Chloe, I think we talked already briefly about relatability, but there are so many people listening right now that are on starting their journey to FI, or maybe they're listening and they haven't even realized that it's possible yet. What you did was break a social norm. I think everyone thinks that, who hasn't discovered FI, that, oh, I'm just supposed to, like, people just live paycheck to paycheck. That's literally just what they do. I need to make more money so I can increase my lifestyle. And then zero wealth is born from that. So once you learn about it, it almost becomes an addiction. Ryan and I were talking about this the other day. As soon as enough money hits our account, we're like, we got to get this thing out of our bank account. Like, what is it doing here? Because it's doing nothing, right? So the question that I have for you to parlay off that is, what did you do? What were your first couple moves? Like after you were like, oh, I'm making 91,000. I had this like, I don't know if you want to call it like an epiphany, right? You had this moment where you're like, I need to do something different. What were the first things that you did to kind of separate yourself and create the gap between your income and your expenses?
Yeah. So I started like most people start in the financial independence community, as I focused on debt freedom. I thought that was like the end all be all when it came to pursuing financial independence, because there's just so much information out there about debt freedom. And so my original plan in that October month when I decided to do this was like, all right, I'm going to run the numbers. I'm going to see how much I'm making, what my expenses are. and just how much I can use to put on debt. Investing was not even on my radar. It was just like, I need to get rid of this ridiculous amount of debt that I have from student loans and a car payment. And so what I did to figure out what I actually realistically had each month is I tracked every single dollar that I spent. I literally had this teeny tiny little notebook that I put in my purse. And every time I spent money, I just wrote it down. And then at the end of 2 weeks, I went through and color coded it. And I was like, oh, wow, this is how much I'm spending on eating out and drinking. And like, ultimately what I discovered is like, you have a ton of money each paid period, but I was blowing $600 every 2 weeks on eating out, drinking, and being hungover. So it's like, here is $600 every 2 weeks that I could be doing something with. And so when I actually had the data of where my money's actually going, I was then able to decide, okay, where do I want it to go? And like, just having that realization, I think so many of us are like, oh, I have no money. Like, there's no way I can't do this. But often it's just going to places that we don't even realize it's going. You know, all of the little stuff that we're doing just adds up until we don't even pay attention to it. And so doing that actually, even though it was shameful and I was embarrassed and I was like, this is depressing that this is what I've been spending my 20s on, is it just made me realize, but I have a choice here and I can decide where I want this money to go. So that was kind of, I had to shock and disgust myself first with my spending to then decide, okay, this is what I need to do moving forward.
So I think one of the main things is people get lazy with tracking their expenses. Like it's easy to say, oh yeah, you know, I write it out, I highlight it. But for people to actually go and take action and do this, they think like, I don't need to do that and I'll be able to get my financial house in order. Can you talk about the importance of actually taking the time and however many hours it takes per week? It probably not that many minutes or hours in a week, but to track your finances and like why it's so important, and parlaying off that, do you use an app or something to track it, or are you going old school pen and paper and tracking it that way?
Yeah, so I went old school when I did it the first time, and then I started using the Google Sheets budgeting template, and that is the template that I still use. So the reason I don't use an app is because the entire reason that you should even be tracking your money is to get to that place where you're actually mindful, where you're paying attention to it just like you would anything else. And if you're using an app or if you're using something that automates it for you, the mindfulness isn't there. You don't have to be mindful. It's doing it for you. So you forget about it. You're not necessarily checking it. And the whole point of doing it manually is to get out of that autopilot where it's just like money in, money out, and I don't really pay attention to it. So one of the first things I always recommend for my clients is like, just track for like a couple months, even if it's not something you do forever. I don't think everybody needs to track forever. But getting to the place where you're going from one extreme of never paying attention to what your money is doing to like, okay, I'm literally going to write down every time I spend money that's over $1, then it's just this change starts happening inside of your brain, and you start seeing money less as this like ethereal thing that I have no control over to something that's actually a tool. It doesn't have any other use other than it's just a freaking tool that's either going to make your life better or make your life a little bit harder. So that's why generally when I'm starting folks out, and like, I'll let people say, you know, if they're like, there's no way in hell I'm going to track, I'm like, all right, we can try something else. Like, I'm not going to force you to do something that doesn't work for you. But my most successful clients do it for a couple of months just to get into that rhythm of like, I know where my money's going.
Cool. Let's talk about what that allowed you to do, tracking, you know, X amount of months. And I guess you did it probably for a couple of years, right? Before, and then you got to see it stack up. How much were you able to pay off in debt and then save up over like 2-3 year period?
Yeah. So the claim to my fame is always that I was able to increase my net worth by $200,000 in 2 years. And part of that came from paying off $40,000 in 2 years, and also saving and investing about $150,000 in that time frame. Now I'm 3 years in, I am not nearly as strict as I was, you know, because I've been doing this for a while, but now it's even grown further in that I've increased my net worth by $300,000 in 3 years. So it really shifted everything for me. And it just started with this super simple thing that truly anybody could do.
Yeah, that's really cool. It's 3 years to save $300,000. It's a lot. Like if people, for us in the FI movement and investors, we throw big numbers around all the time, and it's in a dollar amount, just like kind of doesn't seem like a lot, but $300,000 is a lot of money. So if you're listening to this, I mean, it's one of those things where it probably feels a lot to them listening.
Yeah.
So I'm wondering, there's a lot of people that are listening that are in debt right now, right? And they're just like, I need some help to get out. Can you give us some recommendations or some baselines for your clients or friends, people that you recommend? Like, what are 5 easy steps, or it doesn't have to be 5, but just simple bite-sized points that people can take to get themselves out of debt, potentially start investing and just getting their house in order?
Yeah. So I think the first thing is tracking. Like, first, see where your money is going. So you see what you have to work with. Like, to me, that's everybody's number one step, whether or not you continue to do that. But you just have to get a baseline idea of what is available for you to either dedicate to your investments, dedicate to your emergency fund, or dedicate to paying off debt. Like, without that, then how are you going to make any goals? The second thing is you have to decide what's more important to you. Is it more important to you to have those little psychological wins along the way that, through the snowball method, which is where you pick the smallest debt first and you focus on putting all of your extra money on that smallest debt first? Or are you more focused on, I care about the mathematics. I care about paying off the debt that's going to lead me to pay the least amount of interest rate, the least amount of interest in that set period of time. Then you're going to want to go with the avalanche method. And the avalanche method is really focusing on picking the highest debt, the highest interest rate debt first, and tackling that first while making your minimum payments on everything else. For me, when I started, it ended up being that the debt, that they were both the same. So my smallest debt was also my highest interest rate debt. So I was able to really tackle that. Then when I paid off my car, I used all that extra money to really start putting down on my student loans. But the thing is, what I would encourage people to do is, like, I went into this, like I said, with this mentality of debt freedom's everything. That's all I really want to go for. And 2 years in 2020, I finally realized debt freedom's not all that it is. Like, there's so much more to it. And I would say allow yourself to be flexible. The more you learn, the more you're going to want to change your strategy. And that's okay. You should be doing that. So for me, it was like I had this laser-like focus on putting $2,000 a month on my debt for 2 years. And when I ran the numbers, if I had chosen to invest that money instead, I really am looking at, over the course of 40 years, having $1 million left in my retirement accounts now, because I focused so heavily on paying off low interest rate debt. Because my interest rates on my debt at the time were only 3.54%. So that's what I'd say too, is continue to educate yourself on that journey, because for me, as I continued to educate myself, I could not deny the fact that it was silly for me to be focusing so much on paying off that low interest rate debt. So I guess I skipped a step too, because I do want to say, if you're on a debt paying journey, list off all of your debts and list off all of your interest rates for sure, because that'll give you a really clear idea of what you're working with. And if you do go the snowball route, what are you going to be focusing on paying first? And if you don't go the snowball route, the avalanche, then you've also got a very clear indicator of what you've got to tackle.
Yep.
Love it.
You got one?
We both do. We're itching to go.
Go ahead. I'll wait.
I just wanted to relate this to our real estate investing journey. And just because there's a lot of people who are listening who are investing in real estate as well. And what you said perfectly made me think of when I first started investing in real estate. I'm thinking, I'm going to get 20 doors that pay me $500 a month. And I just need to stack these rentals. I'm just going to stack them, keep them forever. And then the strategy changes as you grow. And this is what's happened for you. The strategy changes. Now I'm like, oh, wow, I have $150,000 worth of equity in one of these properties. Maybe I sell that, take the equity and go buy a bigger deal, right? To get a bigger return, or pull money out and refinance, which is starting a loan over, right? Not having your 30 years resets if you're doing a 30-year loan. So the strategy changes as you adapt and as you get better at it, which is exactly what's happened for you. And I think people need to be able to adapt in their own head to say, all right, this is what I'm going to do. And then how does the market changes or my personal reality shift in order for me to adapt and change. So I just wanted to make that a point there, is that this journey truly is ever changing. And I know that you had something you want to go into, Rob, but I just wanted to relate it to our personal rental portfolio.
No, it was this similar thing going through my head. Is like, do you pay off all your loans? Do you pay off your property or do you not? And you basically that's like the age ever stories. Like, do I keep paying down or pay more payments towards my mortgage and get that thing done and just be debt free? Or do I take advantage of interest rates being down really low and buy more properties and save more money and start investing that? Right. So like, I want to talk about just really quick on your debt strategy too, like the snowball versus the avalanche. For people just starting out, sometimes it's just important to get those small wins, right? And that's why I sometimes like taking advantage and paying off the small interest loans, just because you can, even if let's just say it's $10,000 and it's at 3%, maybe you have another one at $40,000 at like 7%. For me, I just want to get one done with to feel like I did it. And I'm like, okay, now I can tackle the next one. And then, as you said, you get better, you learn more. And as you're going through the journey, you'll probably peel back and start investing while you pay off that $40,000 loan as well. If you go on bankrate.com and you check out the compound interest calculator, it'll change your life. It's incredible. You see all these posts online about like pay off X amount, you'll be a millionaire by 65 and like keep dumping in. It's as simple as going on bankrate.com or whatever profile you want to go on or website and typing in the compound interest calculator. And it lets you play with the amount of money that you can save per month and dump it into a fund that performs at, you could put it between 6 to 10%, 12%, whatever your return is or what you expect. And it'll tell you what you're going to pop out at the end of 30 years. So that's important to see your potential future on paper. That's what I like. And it goes all the way back to tracking your finances.
Exactly. Well, and that's what I always like to do because, in the Lazy Investors course and in my coaching calls, I always get the question of like, Chloe, I've got this debt. What do I do? Do I focus on, paying off this debt or do I focus on investing? Especially when you're somebody who's like starting your late 30s or early 40s, you don't have as much time. So they're like, which one of these is more urgent? And all I do is I run the numbers for them in both scenarios. Like we'll go through a couple of different scenarios. We'll go through the scenario of like all the extra money you have a month to put on your debt. This is what it would look like in 10 years. And then if you only had 20 years left to be investing, this is where your investments would potentially sit. If nothing changed other than this is the amount of money that you had every month to dedicate to debt or your investments, then I'll run the numbers for like if you were putting all of that money in your investments. And then I'll show like, okay, here's if you did a little bit of both. Because I think all of us, or I don't know about all of us, but I think a lot of us struggle with that like all or nothing mentality. And I think that that's definitely supported by, some of the largest voices out there of like, you should only be focusing on paying off debt or you should only be investing. It's like, it does not have to be that black and white. You can do a little bit of both. And like these rules and these extremes really just makes it harder for us to be flexible. And it's like, to be flexible is really the best thing because things are going to continue to change throughout the market. Like we can't predict what's going to happen with the market. A lot of people aren't investing in bonds right now, but that's probably going to change once interest rates increase and people are like, oh, wow, the stock market's way more volatile. Maybe I do want to throw some money in bonds and things like that. And it's like, you can be really frigid, but that's really not going to help. I feel like it would make me so stressed if I was so frigid to this idea of like, no, I have to be debt free by 33. And it's like, I learned new information. I'm allowed to change that plan.
Yep, totally. And just my opinion, I'm not sure if Rye thinks the same way, but my opinion about the Dave Ramsey thought method here. And there's
I didn't say Dave Ramsey.
I'll say Dave Ramsey. It doesn't matter. Yeah, I'll say it. And I'm not about to knock him really. I'm just about to say that I think that if you do not have the financial independence itch, or you don't really know how to deal with money whatsoever, which sadly is the masses, probably 75, 80, maybe 90% of America, follow his strategy. It will help you 100%. But if you're looking to build wealth, it's a different story. And that is kind of the way that I'll tell people, is because you're not going to pay your debt off into financial freedom. You're not going to do it. You're just going to be in a better financial position. And for people who are stuck $300,000, $400,000, $500,000 in debt, listen to him. He has great advice, but don't take that as like the end all be all as how you're going to become a millionaire, a multimillionaire, or bigger. So to pivot a little bit with your story specifically, I know that you mentioned in some articles that we were reading that you're planning to retire by 46. Now, typically, people think the retirement age is 65, right? And that's just what they've thought. You work for 40 years, you retire at 65. You're not like going after this super aggressively, like some sort of like maniac saying, I got to retire in 3 or 4 years. Like, doing all these crazy strategies that you could potentially risk your, not only your livelihood, but like everything, right? So what are your strategies to try to retire by 46? Because that's under 20 years from when you started your journey. And I think a lot of people would get excited like, oh, I can do what Chloe's doing. 20 years is a hell of a lot better than 45 from now if you're in your 20s or 30s. So what's your plan there? How do you plan to attack that?
Yeah, so that is the 46 was when I was still working a regular 9 to 5. I was really focused on, I didn't think Clover Money Coach was ever going to be my full-time gig. Back when I had said the number 46 was my number was because I was working a 9 to 5. And in my head, I was like, I could work this 9 to 5 until I'm 46 and be totally done doing what I was doing then, which was focusing on maxing out my 401k, focusing on maxing out a Roth IRA, and paying down my debt, essentially. But what I realized was one of the things that was holding me back from quitting my job to pursue Clover Money Coach full time was that I thought I really needed to make my exact income that I was making at my 9 to 5 in order to quit. And what I realized was I actually love what I do as Clover Money Coach. Like, this is barely a job for me. Like, it's something I love. It's fun. I feel very fulfilled by it. And I was like, I don't think I would retire at 46 if I was doing Clover Money Coach full time. And so when I realized that mid-year last year, I was like, well, screw it. I'm just going to try to, make $5,000 a month. That was my number. I was like, if I can consistently make $5,000 a month for 6 months, I'm going to quit my job. And like, that's less than half what I was making at my corporate job. But I knew that, okay, this is just me doing it part-time. And, I have the opportunity to scale once I quit. So if I'm able to do that and I have a year emergency fund, then I got this. Like, I'm going to quit and I'm going to do it. And now, from October to January, in that short time frame, I've made over, $70,000 in that time frame. And that's allowing me to invest even more money than what I was doing when I was doing my full-time job. So really the secret to retiring early, it's nothing exciting. It's just, you got to invest your face off. Like, you just got to keep going and like, yes, max out that 401k. Yes, max out that IRA, but what else can you do? Can you get an HSA and max that out? Can you get your taxable brokerage going and throw any excess money into those investments? So my approach is really focusing on liquid investments. Right now, I don't see myself going into real estate yet. But once I figure out where the heck I want to settle down, then I can see myself doing that for sure. But really, that's what I'm focusing on now, is just throwing as much money as I can into my investments. I don't really have the goal of retiring at 46 anymore. But I would certainly like to have the option. And I have no doubt that that's going to be an option for me by the time I'm 46.
I love this sentiment here because I think anybody, this is just my personal opinion, but anybody that thinks that they have a date to retire, like for example, Ryan and I have a goal to be financially free in the next, I think it's like 5 to 10 years. Like, that's our range. But retiring, if you have the kind of the bravado or the courage to go after what it takes to be able to retire at 46 years old, there is about a 0% chance that you're actually going to retire when that happens. And if you think that your mindset's going to shift where you're like, oh, I'm just ready to do nothing now, like it doesn't work that way. It could work that way, but you can also do this. Oh, maybe I'll work on a passion project for 6 months and then take 6 months off. Or maybe I'll only work 2 months and then take 2 months off. Or you have the optionality. And that's the most important aspect of pursuing financial freedom, in my opinion, is that you now have this optionality to your lifestyle. What do I really want to work on? Like, what do I really want to do and really want to be good at? And it gives you that choice that you're not working for the man and you're not putting in all these hours to build somebody else's empire, so to speak. So I just had to shift this mindset personally because I'm like, oh, I can't wait till I hit the certain number. And I'm like, nothing's going to change in my head when I hit the certain number. The only thing that's going to change is my ability to control what I do every day. And that's the most important thing.
I heard a quote, like, if you're able to retire at 40, you won't. Just some, or
Right.
at a low number,
Yeah.
just because you're that much better and you figured out the game and you're gonna be too excited. Like, it's just in our blood. There's no way we would be, you get yourself up to this level where you're just a master and you're just gonna be like, yeah, I'm out. Like, I hate to bring, many people know I'm a huge Tom Brady guy, but like,
Oh yeah.
it's a perfect example of like, the guy is 44 years old and he's still at the top of his game. Like, why would he stop playing?
Yeah.
Like, he's finally mastered. Now it's like he's doing it with eyes closed. And so it's just one of those things where there will be passion projects and things, but I think maybe in our space, we'll just continue to give back, right? And teach people what we know. We just love talking about it at this point. I mean, if you become a master at something and we're going to want to give back. We think about some of our mentors and like people in the FI community, but in the real estate investing game, they're 50, 60, and they're just trying to help us get to where they got to. So it's just an exciting topic. And
yeah, Chloe, you probably can't tell, but we're literally in a full sweat right now. Like our heart rates are pumping. We're loving this. So this is what it's all about. And hopefully, you can do this full time, like you're doing what you do full time. So I think that's awesome. I'm curious if you're willing to share maybe what your current investment portfolio kind of looks like, even if you use rough numbers, like where are you invested specifically, just so people can say, all right, I got my debt. I'm starting to pay off some debt. I'm starting to be able to invest. Where should I even put my money? Like what's the rate of return that I can expect? Maybe just shed some light on that there.
Yeah, for sure. So I am a lazy investor, which means that I really focus on investing in broad-based index funds. And so the majority of my portfolio is specifically in index funds, but those, even within that, obviously there are breakdowns. There's large cap, mid cap, small cap, growth, all of those. I want to say 60 or 70% of my portfolio is specific to large cap, and that's split between some growth and value stocks. Again, all in index funds. So it's not like, I know a lot of lazy investors out there who are like, 100% on BTI. I've definitely got a lot more diversification in there, just because when you only do something like BTI, you're really missing out on the international market, as well as some more aggressive funds within the mid cap, small cap space, as well as growth funds. So I'd say 60 to 70% of it's in large cap, and that's again split between growth and value. And then I want to say 15% is in small cap, 15% is in mid cap, and then I've got like very little in the international because I've got a time horizon that's pretty long. So I'm not particularly worried about being too invested in the US market right now. So I think I'm at like 8% in the international market. I'm not invested in bonds right now just because I am 30 years old. So right now I'm really not focused on any wealth preservation. I'm focused on wealth accumulation. And what else is in my portfolio? I did just recently, this is funny, right before the correction, I invested about $10,000 into some individual stocks for the first time. I was like, all right, I've got this broad base. I've got, almost $200,000 like sitting around. So now I'm finally able to like invest in individual stocks and get a little bit more aggressive. And of course I was like, I'll pick some tech stocks. I'll pick a couple of value stocks. And immediately it's like, and it's down $1,000.
This happens I was talking to Ryan before
every time.
I invest just a small amount in crypto. I'm not kidding. Every time 20% down. What? Oh, I have some extra money this month. I'll throw it 30% down every single time. So it's like, all right, I'm just going to do it monthly, right? And just forget about it. And maybe answer this first. Do you do this monthly? Like, do you invest monthly, weekly? So now that I'm a full-time entrepreneur, I really just do lump sums. So anything that I get that's over my emergency fund and over what I need for taxes, I just throw it into investments. So I don't do it on a monthly basis. I mean, it probably ends up working out to be about a monthly basis. But before last year, when I was still working a full-time job, obviously I was dollar cost averaging into my 401k. My Roth IRA, I was still doing lump sum. I'm trying to think of what else. Oh, and also to add to it, I didn't mention, I do invest in crypto, but it's like 1% of my net worth right now, because it's like, I do the dollar cost averaging of that, as like you said, because you're going to see those huge dips. If you throw $10,000 into crypto, you're going to like have a heart attack the next day if you're not prepared for it. So doing that over the last, I think 9 months or so is when I've been investing in crypto. It's wild to see, if I had invested that money in the S&P 500, I would have done a lot better, but it's at least nice to see and experience crypto firsthand so I can have an actual opinion on it. But, I'll probably keep doing what I'm doing on the crypto front, even as it continues to crash and burn. Yeah, exactly.
It's funny that we do talk about this with a lot of people in the FI community, and I feel like everyone's invested in crypto, but it's only like 10% or something of people, or
oh yeah, the stat came out. We talk about investing in crypto is like a new thing for almost every single person that we've had on the show, at least in the last like 3 months, which is like 15, 20 episodes, and they've all said it. And then so we're like, oh, everyone's investing in crypto. And a stat came out, and don't quote me on this, I don't know where it came from. I don't 100% know that it was verified, but they said that the percentage of people in the United States that invest in crypto is 8%. So it's like,
Whoa.
nobody's investing.
If we scroll through it's because who we follow on Instagram.
Exactly.
That's our whole community. We're like, oh, dude, the whole world's in on this. I got to dump some cash into this or I'm going to miss out.
But that's funny too. Mark and I always talk about how we think that everybody knows what an index fund is. But then if I ask 10 of my closest friends who are real life close friends, not one of them would know what an index fund is. Maybe one of them would know.
Please enlighten listeners right now what an index fund is, please, because we talk about this all the time and I don't think it's been broken down. If you know, and I'm putting you on the spot. So
if I know, it would be very concerning if I didn't know. Okay. So the way that I like to explain it to people is that an index fund is like the difference between buying a chocolate bar and a box of chocolates. So when you're buying a chocolate bar, you're buying one stock, you're buying you're buying one thing essentially. It's that Kit Kat bar, it's that Snickers, it's that one stock. When you buy a box of chocolates, you're buying a bunch of different things inside of that box of chocolates. So you're going to have, Apple, Amazon, Google, all of these different stocks inside of that box of chocolates. Now, you can't go to the store and say, hey, I just want to buy one chocolate out of that box of chocolates. You have to buy the index fund as a whole. You got to buy the whole box of chocolates, or you got to go off and buy your individual candy bars.
Love it. That was actually a really good explanation.
He was like, I am getting it.
I wanted to hit it with the Forrest Gump line so bad, but I'm not doing it. Can't talk about chocolates and not say the line. It's killing me not to say it, but I'm not saying it. So from there, this is one that I get a lot too, and I want your thoughts on this. What would you recommend, mutual fund or ETF in terms of index funds, right? So I'm thinking like VTI or VT Sachs, right? Those are just coming from someone that's studying this, I just want your thoughts.
It totally depends on the person, because the thing is that with the mutual funds, and for those of you guys who don't know, mutual funds can be actively managed or passively managed. So if you're investing in index mutual funds, those are passively managed. Those are the ones that I care about because they are low fee. And most of the time they're doing better than the actively managed counterparts. Actively managed just means that somebody's literally inside of that box of chocolates, buying and selling every day to try and get the investors as much money as possible. But most of the time they're actually not able to beat the passive counterparts. Index funds can be ETFs or mutual funds. So mutual funds, the benefit of a mutual fund is if you're buying at Vanguard or Fidelity or Charles Schwab, you can automate that investing. You cannot automate ETF investing if you're using a traditional brokerage. If you're using a robo-advisor, you can automate that investing with ETFs. But, with robo-advisors, depending on which robo-advisor you use, you can't really customize as much as you would like. So if you're really focusing on building a portfolio that's as hands-off as possible, that you're automated into monthly, then you probably want to go with mutual funds. Unless you're using a robo-advisor, then you could stick to ETFs. But the nice thing about ETFs is that they're a little bit more liquid than mutual funds, because mutual funds you can only buy and sell once a day. Now, for most of the people who are listening, they're probably not day traders. So, does that really make a difference to you? Probably not. So when it comes to ETFs or mutual funds, sometimes it's as simple as, well, how much money do you have to invest? Because if you're going with Vanguard or you're going with Charles Schwab, there's a minimum that you have to put into a mutual fund in order to start investing. And usually it's thousands of dollars. So it could be from $1,000 all the way up to $3,000, depending on which company you're going for. ETFs, you're not going to have that same problem. So specifically, if you buy ETFs, there's a lot of brokerages that allow you to buy fractional shares. So if the ETF's $200 and you're like, well, I can only invest $25 a month. Well, you can do that if the brokerage you're using offers fractional share investing like Fidelity, or if you're using a robo-advisor again. So it's kind of like, it just depends. There's not like a catch-all answer of like, yeah, you should always go with mutual funds or you should always go with ETFs, because it depends on your situations. I will say most people who I work with probably end up going with the mutual funds route just because they want to automate it. But if they don't have that much money to invest every month, they're usually going the ETF route and just doing it manually.
That's cool. I go the mutual fund route, but
that's funny. I don't know if we talked about that because I buy ETFs. So it's
interesting.
I have Vanguard, so I don't think it allows me to do the fractional shares. I despise that. Like, I just want to be able to throw X amount of dollars. Like, I don't want to buy, like, I get it. It's for the shares, but it's so basically for VT Sachs, VBTLX, and VTIX. I believe those are the symbols. So that's like the three fund approach, right? You have the US stock market and then international stock market and then the bond market in the US. So that's a simple approach, but it is $3,000 to get into each one of those. However, once you're done, it's like, okay, throw whatever you want each month. So I just set auto investments every 2 weeks, right? And then I also do that in crypto now too. I know it's not a mutual fund, but it is fun to get into that game and play with it just so you have an opinion on it. So I love automatic investing. And you talked about this way back in the beginning of the episode. Is like, all of us in the community, we learn more and we want to become as efficient as we can with our finances. And it throws me off every day. I learn something new and I'm like, damn it. Like, I just want to add this to my scheme. Right. And then it takes a little bit of time to weave it in, but I'm all about efficiency and like not thinking about it, because majority of our investment brain, I guess, or like our time spent is finding real estate investments, because that's just our thing. That's what we like. And it's tangible. It's not something that I'm just like hoping goes up eventually. Like if we ran the numbers right, it should continue to produce X amount of cash flow based on how we kind of strategize. So interesting thought there. I just think if you're OCD and you are type A and you just want things automatic, probably go the mutual fund route. However, you're not going to get exposure everywhere if you go I mean, I guess you could, but the mutual fund route, if you have only $500 and you want to get in, and you don't want to wait for the 3,000, then I'd advise going the ETF route. I have a mix of both. I think QQQ is one. It's an ETF, and that you can't. I don't know that there's a mutual fund for that, but that's one of the ETFs that I'm investing in. I love it.
Yeah, I like ETFs because I just have a number, call it $500 a month, that I'm just putting into ETFs. And I have a couple symbols that I really like, but they're $110 a share, $56 a share, $47 a share. I just divide it up by 3 and just put it in. That way your dollar cost averaging kind of takes over there. So I think it's very, very cool to watch, you grow this net worth, and then you realize like it really does. The hardest part for you is already done. Like you have already accomplished what very few people have. And now the fun starts because compounding, right? Now compounding is we're recording this on the 24th, and January has been horrible in the market. So you have a lot of money in there. A 10% return, a 10% hit's going to be bad.
It's not good.
No, it's not going to feel good.
But this is where you get stuff on sale. Like, I mean, I know it's a correction, but everybody's like, buy the dip. Like that's a thing. That's actually a thing. And you're not going to do it every time, but I'm just attributing this to crypto, and the aspect is like, it's down so significantly that the last time it was down, I'm thinking Bitcoin. I think it was like November, the last time it was down into the 30,000, and people were like, oh my God, I wish I just invested in that. Bitcoin hasn't changed. The price went down. So if you loved it back then and you love it now, buy it. That's kind of the thing. It's like, it is a sale. I think people get annoyed because they spent their cash and they don't have it now that it's down on sale. And like, damn, like I had no reserves to pump into this, where you kind of need an emergency fund reserve, but also an investment reserve for when these things happen, so you can capitalize.
Yeah. That's the next question there. So based on you saying, oh, I don't do this monthly, I do it whenever I have enough like income coming in that I feel comfortable. What is your emergency fund rule that you have? Rye and I are probably like a little bit lax on that because we love investing in real estate. We might take a little risk with our emergency fund because we have a bunch of different flows.
6 to 12 months.
Yeah, but that's per property. But I'm saying like a personal one, like I'll let it go a little bit lower than like traditionally it should, just based on the fact that like I know I'm getting returns in real estate. But Chloe, what is your emergency fund? Like how much money do you like to have in cash just in case, worst case?
Yeah. So when I was preparing to quit my job, my biggest goal was I wanted to have a year emergency fund, because I was like, all right, I know for some people, getting off on the ground and starting off a new business, it can take a really long time for you to start turning a profit. But do I need a year emergency fund? Probably not. Just as a new entrepreneur, it makes me feel a little bit more comfortable having that. But I have slowly started investing part of my emergency fund just because now I've had a proven business for almost a year.
Right.
And the income's just continuing to go up. So after probably a couple more months, I'll probably invest at least half of my emergency fund because it is such a large number. But generally I say 3 to 6 months is best for most people. And if you're an entrepreneur, I like going on the, 9 to 12 month just for the just in case, because you're depending completely on yourself at this point. But like you guys said, you guys have cash flowing properties. You don't necessarily need as large of an emergency fund because you've got all these different streams of income.
Right.
Right.
That's when the game gets fun for sure.
Right.
So, do you go 9 to 12 months of expenses or income from your job? Like say you make 100 grand per year. Are you going to just divvying that up by 12 and saving that?
No, I do my emergency expenses. So it's like, if I wasn't making any money, what would I still need to pay for? That's how I calculate it. So it's not nearly as much money sitting in cash as a year. I think it's right now I have like $35,000 in cash.
Got it.
Cool.
Okay.
Yep.
Yep. It's interesting. Everyone has a different take on it, but I like your approach, especially for entrepreneurs. If you're going to get out of the game, then you also got to factor in too. We've talked about it's so great to be an entrepreneur and like run your own life, right? You're working probably 100 hours a week, not 40. And you also worry about insurance and benefits, right? Like you kind of forget the perks of a 9 to 5 and you're like, let me just get out of here. And then there are some perks to both. So it takes a specific person. So congratulations on it. I mean, it's amazing what you've been able to accomplish in such a short amount of time.
Thank you.
Yeah, absolutely. With that, let's kind of transition over to that. So we want to talk about your website, blogging, and then your coaching. So can you just talk about what you particularly offer within your coaching? Like, is it hands-on, one-on-one? Is it still open, available for people to jump in if they like have been enjoying the interview and they're like, wow, I need to go with Chloe. What can she offer?
Yeah, so I'm actually taking a break from coaching right now and focusing on the Lazy Investors course. So the main way that people can work with me now is through the Lazy Investors course. I open up to new students once a month, but it's pretty cool. It's, a self-paced course, but there's live coaching that goes in with that twice a month. I'll probably pick up some new clients again in the spring. It's just I've been doing so much coaching for the last year. I think I coached over 300 people last year in that short time frame from March to December while working a full-time job. So I'm a little burnt out on it, even though I love it. So right now I'm on a little bit of a hiatus from coaching probably until the spring, but, the Lazy Investors course is the best way to work with me. You've got that access. It's more information than I could ever provide in just a one-on-one coaching situation. And you also get that group coaching benefit as well.
Let's talk about that. Can you peel back all the layers of it? Like what's within the course and how can people get involved?
So the Lazy Investors course is about 15 hours of recordings, really just taking people through how to become a lazy investor. And like I said, my approach to lazy investing is really focusing on indexing. I walk folks through the basics of, why you should even be investing and what to do when the market crashes, the history of the stock market, to diving into basic terms and understanding the different retirement accounts out there, as well as, how do you balance your portfolio? What are the allocations that you should be considering? What kind of an investor are you even within the lazy investor space? So it's got 7 modules. It's got 5 bonuses on, basic stuff of, money and mental health and jobs and negotiations. One of my things that I've talked about a lot is I was able to take my income from $42,000 a year to $130,000 at my 9 to 5 in less than 5 years. So I've got some education on that as well. But really the main focus is how do you learn how to invest in a way that you don't need a PhD or a CFP in order to do it? Because most people, when it comes to investing, I think we all think it's a lot more complicated than it needs to be. It's really not. And the whole course is about really focusing on giving you the information you need rather than all the BS that you don't need so that you can just get started right away.
I love that. And we tell people oftentimes on Instagram, if people reach out to us and ask, where do I start? What do I do? Your course sounds like a great place for them to do that. But consistency, patience, and diligence is, in my opinion, 80% of it, right? If you just keep doing it, like we were just talking about the market being down 10%, I'm still investing on the first of the month. I don't care what the market's doing because I'm not pulling the money out today. So it doesn't matter, right? So continually be consistent, diligent, and patient because there are very, very, very few millionaires that are made in like a year span. It just, you can get lucky. You can invent something, right? But I'm not that smart. So I'm just going to do it over time.
and people are lazy. Let's talk about the Lazy Investor course. Like, why do you have the name The Lazy Investor? It sounds appealing if I don't really want to have to pay that much attention to my investments.
Because that's exactly what I get most of the time is the people who come to me for coaching, they don't want to do anything complicated. They don't want to be, a day trader. They don't want to be focusing on option trading and things like that. They just want a system that they can set in place and automate it for the next 40 years so that they don't have to worry about it and that they know they're making the right decision. Because I think so many of us go into investing or go into our finances in general, and we're just like, oh my God, how do I even know I'm making the right decisions with my money? And so focusing on, okay, there's a lot of stuff out there. Here's what you actually need to know in order to make effective decisions and really set your portfolio on autopilot.
I think it's incredible. It not only sets you up for success in the future, but there's this sort of, and you probably talk about this in your course because I know you used to write on mental health. There's just such a cloud lifted or a weight lifted off of you when you have this set up efficiently and you know it's good. When you're at the point where everything's already picked out, you have it all set up, and it's just the cash that gets pumped into it, you can then focus on making more cash and cutting out more debt. And then that's when the game starts changing, right? And then you have more money. You're like, oh, wow. Like I forgot that money was even coming in. I checked my account and it's stacking up and compounding now. It takes time, right? And time is one of the biggest factors in this whole thing. So it's start as early as you can. But you're never really too late. You just have to start putting more in the later you are. So very important stuff. I also want to talk about, you obviously are an expert in the space, and you spoke at FinCon this year. So I want to touch on that. Can you tell us, for people that don't know what it is, can you tell us what FinCon is and then the topic you covered?
Yeah, so FinCon is literally a conference for finance creators. So finance creators could be anything from bloggers to podcasters. That's really how it started, was bloggers and podcasters. But now influencers, I say with air quotes, I don't like calling myself an influencer. I call myself a creative. So now a lot of finance creators are coming into FinCon as well to really talk about that, because it's a huge space and it's something that is completely changing the landscape on how people are getting information. But even obviously in the last 2 years, we've seen a huge influx of finance creators out there. So it's a really cool opportunity to get together with all the other finance nerds that are out there that are doing other really cool stuff. So it was actually my first year going last year. And I got chosen to speak at FinCon as well, which was really exciting. So I spoke on a panel that was really focusing on, money and being a human being. I think there's a lot of finance content out there that tends to shame and judge people, into doing whatever it is that the creator wants them to do. But personally, I don't think that's super effective. I've had a lot of people who have come to me after going through a very, shame-filled and judgmental program like the Ramsey course. And they come to me and they're like, I don't know what to do now. Like, I feel terrified to go into debt. I feel terrified of credit cards. I feel like I have no control over my money because I had all of these very strict rules set out for me. Now I have no rules, and what am I supposed to do? So really the talk was focused on how do we bring empathy into the space, and how do we know if we're causing more harm than what we mean to be doing. So it was a really cool talk. And it was fun to work with other, professionals in the space.
That's really cool.
Yeah. I think that's something that we definitely want to go to. And,
oh my gosh, you guys have to go.
Yeah,
you guys didn't go last year?
We saw all of our friends there. I'm like, I jumped on your live one time because you were just you were giving a recap on the thing. I'm like, I know all these people. We've talked to half of them. This is stupid. Why were we not there?
Yeah, we got to go.
It's so fun. And honestly, you don't learn that much from the sessions. No offense to FinCon. You learn from hanging out with your friends. You learn so much. And what I will say is prepare your liver, because I had no idea finance creators would stay out till 4 a.m. every night drinking and talking about what we do.
That's great. Sounds fun.
Yeah, and
it's a good time.
We already like talking about it, so I can imagine the alcohol would probably add a couple more.
Oh my gosh. And you just get so many people from so many different experiences. You get podcasters, bloggers, Instagram influencers, TikTokers. It's just the amount of knowledge there. It's wild. It's really cool.
Love it. Cool. So we definitely got to go, but we made it to the second to last segment of our show. It's called the Core Four. We're going to ask you 4 questions, kind of get to know you a little bit better, maybe figure out what makes you tick.
Cool.
First question. Yeah. Good luck. First question. What is your favorite investing or business book? Maybe that helped you kind of jumpstart your journey.
Oh my gosh. Honestly, it's The Millionaire Next Door. The Millionaire Next Door was like the first thing that made me realize how powerful it can be to just really analyze where your money's going and decide where you want it to go. And also I love it too, because it really reinforces the importance of just like maxing out your 401k. Like it's one of the tools that so many people have that is so available, so easy to invest in. It's like such an easy win. And that book really highlighted just like how many millionaires next door are just doing it through their 401k.
Love it. That's a good one. I will say that it's a great book. It was hard for me in the beginning to get through. Just the way it's written is, I don't want to say like super dry. It's not conversational to me in the beginning. And I was like, okay, I had to get through it. But the cool part was you see how many people don't flash their money, and you don't realize how many people are way more successful than they look. And I don't know. It gives you, how do you call it? Like little examples, I guess, of case studies. There you go. Of each different person and like what they did to reach financial independence. And everyone was a little bit different, but they weren't driving the Lamborghinis. They weren't driving the Range Rovers. They didn't have the massive mansions. It's very cool. And it's called Millionaire Next Door, right? So it kind of is what it says it is.
It is really cool. And it just like, it really helps you rethink what you're doing. And at the time, like before reading that, I was such a spender. And it really helped me reframe. Like, if you want to have a life like this, where you're not worried about money, like this is your first step.
Mm-hmm. Yeah, I think it's a great book for people to get started. So second question of Core 4 is, what's been your biggest mistake on your investing journey so far, and how have you learned from it?
Okay, so probably my biggest mistake on my investing journey was one of my very first investments before I knew anything about investing was investing in a private money lending situation. So I had a contractor who I had been friends with for like 15 years, had seen his business explode, and he was looking for investors. And so I put in, over the course of like a year, I put in almost, I want to say $20,000, or so. He grew it to $60,000, but he's owed me the payout for like over a year now. And I'm like,
oh, really?
Whether or not I actually get back my cost basis and everything I supposedly made, totally, who knows? I have no idea if I'm going to get it back or not. But what I learned from,
Are you still friends with this person?
I wouldn't call us friends. I would just say we're acquaintances at this point.
Yeah, right.
But he's getting sued by a lot of the people who invested with him. And I've known him for so long, I really haven't decided what route I'm going to go. But ultimately, the lesson for me was, luckily, I'm at a place right now where if I lose that money, it's really not a big deal. Like, it's not going to impact my numbers. It's not going to impact whether or not I'm able to retire, which feels like such a huge flex. Like, cause I'm like, wow, I'm not actually worried about getting back 60 grand. Like, if you had told me that 3 years ago, I would have like shat myself and just been like, okay, well, I'm going to die now. But
it's crazy. It just kind of shows you anything's possible. And like that is, it is kind of a flex, but it's awesome to be able to say that and to know that you're still in a good financial spot, whether or not you ever get that money back.
It's a good warning though, for people out there. There's a lot of quote, air quotes here, gurus and people out there that they will take your money, and they may, and when I say take it, they may use it, right, to benefit themselves and then say they're going to benefit you. But at the end of the day, if you don't have everything in writing and like terms and conditions, legal, like through an attorney, then you're kind of at a chokehold. They got you in a chokehold. Or did you have it in writing? I assume you did.
Yep. So I have everything in writing. I've got like all the legal documents and things like that were written up by a lawyer. But the biggest fear is that he's just going to declare bankruptcy, and like your contract doesn't protect you from that. So at this point, like I said, I'm not particularly concerned about it. But what I learned from it, when I tell people, and like I'm very open about it on my page, like I give people updates. I'm like, so you guys want to hear about how my worst investment choice ever is going? I think it is important to share the losses too, and to be really honest about the stuff that doesn't work, because what I learned from it is like, you should never be investing money that you're not willing to lose in such a risky thing. So I did not know it all, though. This was like in 2019, before I was even investing outside of my 401k. So that's what I tell folks is like, if I make the money back, it was a decent investment. If I don't make the money back, it was obviously the worst investment that I ever made.
I appreciate you sharing. I think the losses are like, I enjoy sharing my own just because I think it helps people the most to hear what other people's losses are.
Really?
And if past performance is indicative of future results, then probably the same thing will happen to me in crypto. So I whatever.
I was about to say, this is perfect. It's perfect translation to crypto. It's like, just don't invest if you're not willing to lose money. People text me and they keep showing me their portfolios, right? And it's down, it's up, it's down. And they're trading it as if it's their like a brokerage account or their Roth IRA. I'm like, you're ridiculous. I don't know why they have so much of their money in there, and they're just riding the wave. They're like, oh, I had two people reach out to me today and in a group chat, and they were like, yeah, the market's real down. I think I'm going to sell and just call it a day. And like, maybe I'll jump back in when it comes up. That's literally the opposite of what you're supposed to do. You're pissing me off. The fact that we're friends and you're doing that is pissing me off. Have you not listened to one of our episodes ever? Like, that's really upsetting.
It makes no sense. You're literally saying that you believe it's going to go back up, and then you're going to like, it's
the logic behind it was horrible. And one of them was younger too. And they're, right out of school. And I'm like, it's what they're seeing online, right? And they're just like, oh, I'm just gonna ride the wave, and then when AMC comes back on, or Dogecoin, whatever, they're gonna to the moon. I hate that. Honestly, I hate that shit. It's annoying. It's like, it's funny, but people really are using their hard-earned money and losing it. And maybe they'll make one quick hit, but it's not sustainable over a long period of time. And then I just think about all the money they could have put into the market in an index fund, right? It's going to be slow. It's going to be steady, but then you're going to wake up and you're actually going to have cash. If you can do that and then play around with the crypto, totally fine. I know. And I could be way off base. The crypto heads could be like, you're wrong, dude, but that's how I feel.
For sure. No, I agree. And that's what I tell people is like, my approach to investing in crypto is like, I'm only willing to put money in that I'm willing to lose. So it's like, I learned my lesson through this terrible private money lending situation. And like, I'm not going to do that again. And ultimately, you gotta make sure you're comfortable with the risks, and based off of the risks, you decide how much you want to put in.
Totally. Couldn't agree more. So third question of the core four. Chloe, let's say you're handed $50,000, just like a lump sum. You don't have to pay taxes on it one time. What would you invest in, or maybe you wouldn't invest? What would you do with that money in present day?
I am so boring. I would just invest it. Just put it right into my investments, probably into my taxable broker. Yeah, I would have to put it in my taxable brokerage account, and just keep doing more of what I'm doing. Honestly, I think I need a little bit more value stocks in my portfolio. So I'd probably specifically buy some value stocks because I've got a lot of tech. And obviously, I think all of us saw with the dip, the overvalued tech market over the last couple of years, we're seeing really the crashes or the correction that we saw over the last week, really the last month, isn't impacting the value stocks in the same way. So I was like, you know what? It's probably about time I get a little bit more value stocks in my portfolio. So I'd probably take at least half of that 50 grand and put it in some value stocks.
Can you give us an example, not saying what you specifically invest in or advice for anyone, but like just to give an idea, like, what do you like right now? Is there like a one or two that you're just like, you have your eye on there on your watch list?
So I love QQQ, the one that you guys had mentioned, the NASDAQ 100 ETF. That one's a fantastic one. It's definitely all, like 50% of it is like in 10 stocks, I want to say. It's
Apple, Microsoft.
A
lot of big tech.
Yeah, exactly. I do like that one. I also really liked VGT, which is another growth technologies ETF from Vanguard. But again, like, I'm a little bit too much in tech because I am focusing so much on those. And then when you think about VTI and VTSAX, like, those are also really heavily weighted on tech. Like 30% of those funds, which everybody's got, have tech in it. So I'm trying to think of any other big ones that I've got. I did just recently get my thing is I'm always looking for, what am I lacking in? Like, what do I need to make sure I have a rounded out portfolio, but an aggressive rounded out portfolio. So over the last year, I've really been focusing, throwing money in small cap and mid cap, as well as some growth stocks. Now it's like, after doing that for a year, I'm like, okay, you should probably put some value stocks in there. I can't think of the ticker symbols off my head because none of them, I think, was it VOOV might have been the one that I bought last week that was specifically an index fund for value stocks. but there wasn't like any particular one that's coming to mind other than QQQ and BGT. But like, that's obviously not a recommendation, because I'm like, here I am probably oversaturated in the tech industry, which, I'm comfortable with that.
Your boy is
but
too.
Now,
that's where I'm at. So
yeah, I'm good with that. I'm pretty confident that that's going to continue to trend upward. But the reason that I was like, I should probably do a little bit more value is, historically speaking, if we look outside of the last 20 years, value stocks outperform growth stocks over the long term. That has not been the case for the last 20 years because we've been on this crazy bull market with the tech stocks. But I just want to make sure, I'm well diversified enough. Now, I'm not going to do like, 20% of my portfolio in value stocks. It'll maybe be like 10. But that's what I'm moving into. Does that kind of answer your question?
Yeah, I like that. Thank you. I appreciate it. I want to ask you one selfishly, just because we talked a lot about tech. So what are your thoughts on the metaverse here? And specifically, have you dove into the Meta ETF? It's super cheap right now. It's like $13 a share. And I'm just curious of your thoughts, because it has a lot of like NVIDIA and things in there.
I don't know anything about it. Like, I have not paid attention to it at all. I've been so deep inside of just getting a course out that I'm like, after I got the course out, I was like dead for a month. And so now I'm like just getting back into the swing of things of like, okay, I don't have to kill myself for this course anymore. Let me like get back into like paying attention to what is going on in the news. So right now I don't have enough.
Maybe stay off the news for a day or so.
Oh my gosh.
We have I don't know if we told anybody, we have microchips in our brains already, so we're ready to go into the future.
What do you? Oh my God, I love it. What do you guys think of the Meta, since you guys obviously know more than I do?
Honestly, I don't even want to go into that rabbit hole because I don't like it, but that's just me.
We're opposites on it.
Yeah.
To be completely
it's not about it.
I think it's great. I think it probably parlays into like, I played video games a lot growing up, and you were out play basketball, dude. Like, and not saying I didn't do that as well, but that was just kind of like our little niche. And you see kids locked in on no one's outside anymore. They're locked in their iPads. This is a hilarious meme I see all the time, is like, we were told like, stay away, don't sit so close to the TV. Now people have it strapped to their eyeballs with the Oculus thing. So I just think whether it's a good thing or not, I'm not going to go there, but I just think it's the way of the future. And
I totally agree with that.
It's just, that's all I meant. And basically like this one ETF is so freaking cheap right now. And I don't know. It has like 50 companies within that are in the metaverse, but a lot of the big ones are Facebook, NVIDIA, and like just big hitters that are doing well right now, but everything's so far down. So I don't really know where it's going to go. I just think that there are going to be like 3 or 4 big players in it eventually. And it's just like picking the right one right now, because I believe in the next, 5-10 years, technology just like 10Xs itself every year, something like that. So it's wild west right now. And it's also interesting to see that people buying these what are they called? NFTs, but they're using crypto to buy them. So it's like crypto's weaving itself into the real world, and like banks are starting to potentially let people use it. So I don't know. That's a whole rabbit hole that we probably don't have enough time to go down, but it's crazy. It's just crazy to think about.
It really is wild. And that's the thing, is why I'm comfortable with with my selection of tech stocks, is like, I do think it's just going to continue to be a wild ride for tech. But yeah, in terms of Meta, I'll have to do some more research and I'll get back to you on that.
Appreciate it. Cool. Great. Fourth question.
I like this question. It's my favorite question.
Favorite one.
So this question is, what do you want your legacy to be? So why are you doing this whole thing? What gets you out of bed every morning to do what you do?
Yeah, my big thing is, I just really think that the world would be a better place if more people had money in their hands. I think right now, the way that our world is like, so few people have money in their hands, that it's a very biased world. It's a very leaning in that one direction world that we're living in. And if I can be part of getting more money into the hands of more people, then I've done a really good job. And that's why I do what I do.
Love it. I think that's a great answer. And we always want to bring on people who are willing to help others. And I think that, every now and then you get a couple haters in the Instagram comments talking about you're trying to sell this and that. And like every single person, I'm pretty sure, I could be wrong because I don't know everybody personally, but all these people that we brought on our show, you included, these people are out here to help. And that's really what it comes down to. And almost with the thought that like, we didn't even know we could help. And now that we are, I feel a duty to do it. So I'm going to continue to do it. And I don't want to hear anybody coming at us with some negativity because we got none in our heart.
We're never going to
so.
put any gurus on here that are going to just come on the show to sell you something. It's like they're vetted. So that's why they're on the show. Yeah. So that's the little PSA for everybody.
Yeah. We're getting starting to get some hate, but you know what
I hate there. I'll just give you one while we're talking about hate. I truly like it bothers me when you put out like a post or something and you're talking about the future in 30 years, right? And like in 30 years, you'll have $1 million if you do this. And you get someone's like, oh, $1 million won't be worth anything in 30 years. I'm like, buddy, you are the one guy that is guaranteed not going to have 30 million. Is not going to have $1 million in 30 years. For even saying that, there's just like always one troll. I'm like, dude, no one's complaining about an extra $1 million. And if you have an extra $1 million by then, you're going to know what to do to make even more than that. So
yes, and you don't get to multiple millions until you have that first million. That's what I don't get. It's like the whole point is for you to see a future forward. It's for you to see the path forward. And like if you can't see the path to that first $1 million, you're not going to get to your $6 million, your $10 million. You've got to get that one first. And you know what? Some people, $1 million is more than they'll ever see in their entire lifetime. So it's like, yeah, it may not be as much as it is right now, but I tell you what, I'd sure rather have $1 million in the future than no $1 million.
Exactly. That's my exact response. I mean, I kill him with kindness a little bit, but you would not be upset with $1 million. And there's something about it too, is like you became a millionaire. I don't know what everyone's story is growing up, but I can say for a fact that if you make it in this lifetime to become a millionaire, there's something in you that's like, wow. Like that is some level of success.
Totally.
Yep.
I don't care who you are. I do not care who you are.
Yeah. And
absolutely.
Yeah. And look, it's not our platform isn't for everyone. I would be lying if I said that I knew everyone was going to agree with everything we said. So, but it's just funny that we got on that topic.
Yeah. Trolls, the bigger you get, the more you're going to get.
Yeah. We're cool with them anyway.
Yep.
Cool. We made it to the last drop. So last segment of our show. And the last drop is, what advice, Chloe, would you give your younger self if you can go back to maybe your late teenage self?
Gosh, if I could go back to my 18-year-old self, I'd be like, Chloe, there's this thing called a Roth IRA. Like, I know it sounds really boring and really confusing. I just want you to put $200 in a month, make it a thing, do it for, now until you're 27 years old, because it wasn't until I was 27 where I was like, okay, I should probably learn about this investing thing. But if I could just like get Chloe, even if it was just like VTI every month, like $200 into VTI every single month, I wish I could go back and do that. But also the other thing that I wish I would tell her is just like, it's going to be okay. Like at 18 years old, I had no idea what I was going to do with my life. I had no idea where I was going. I had originally thought I was going to go away to school. I ended up at community college because I had gone away to my school and hated it. And so I came back and I kind of just thought like the rest of my life was ruined because of that, being a melodramatic 18-year-old. But I tell you what, I could not have ever predicted my life would turn out this way. And it is better than anything I ever could have imagined. So I really wish I could just go back and be like, hey kid, you're going to be okay. It's going to be great.
I love that answer. And, education institutions they're going to do whatever they can for the next 50 years to make it seem like you still need it. And I am not knocking going to college whatsoever. We both went to college. We loved our time there, but you 1000% do not need it to be successful. And especially you don't need the statured school that is ranked in the top. You don't, but I'm not knocking the W-2 or going down that path, because there are great ways to create great active income that's coming in for you to be able to go invest in other things. So you just don't need it. And if you're going to go into $250,000 of debt, I would say don't.
If it's going to provide you with happiness and something you're excited to go to work every single day, then do it. Like I just think about this. You wake up at, I don't know, 22, and when you're done college, you're like, oh shit, I have to pay bills now and I'm on my own, and I have to money is a thing. It's not all about fun. And so I say that money buys options. It doesn't buy happiness. And I think if you can find something that's worth going and spending your 40 hours a week going to do, that's going to pay you in return, and you're happy to do that every day, great. Then you found what you're supposed to do. But if you're not there, go pivot and do it, even if it pays you a little bit less, because you're going to be that much more happy to go do it. And it's just, we could talk about this for days on end, but it's really sad. I think that's where you said a lot more people would be better with money in their hands. And I think that for me, they will be in the aspect of there's less stress, right? And there's more freedom. And that's why they're better off with money in their hands. So they can go find their passion and purpose and thing that they want to do, because
and then in turn provide value for other people. Like that's what
and like you said, more options. That's what it's all about. It's like more options, giving more people more options.
Love it. Chloe, this has been awesome. Thank you so much for coming on. I really had a great time just chatting it up. If people want to learn more about you, they want to network, they want to follow your story or connect, what's the best way for people to get in touch with you?
Yeah, you can follow me. My biggest platforms are on Instagram and TikTok, and you can follow me at Clobear Money Coach. It's BARE, not BEAR, which so many people confuse. But yeah, drop into my DMs on either one.
And just be careful, because Chloe has like 94 hacker accounts out there that are always trying to get her. So just make sure it's the right one.
We'll link the real show in the notes.
Totally.
The real show. The
real
page.
show.
Sorry. Yeah. The real social.
So Chloe, this has been amazing. Thank you so much for coming on. We really appreciate you sharing your story with us, and cannot wait until you reach millionaire status and doing whatever is that you want to do, because we know you're good at it. So thanks a lot.
Thank you so much. This was awesome.
Thanks for tuning in this week. If you enjoyed the show and like what you heard, please subscribe, share with friends, and leave a review on Apple Podcasts. The more ratings we get, the more eyes we'll get on our show, and in turn, we'll be able to provide you all with high quality guests. It's simple. Open your podcast app, type in our podcast name, The Weekly Juice, click on reviews, and let us know what you think. Thanks so much, and see you next week.